Imagine a company powering the world's biggest gaming championships, boxing title fights, and pro sports launches. Yet its stock still trades for just a few pennies. ESE Entertainment Inc., trading under ENTE F on the OTC and ESE on the TSX Venture, is a microcap entertainment infrastructure company priced around the 5 to 7 cent range. And in this video we're breaking down what the business actually does, why revenues just exploded, where the risks are, and who this kind of setup might appeal to. Quick reminder before we go any further, I'm not your financial advisor. This video is for educational and informational purposes only and is not financial advice. Penny stocks and small caps are very risky and you can lose all your money. So always do your own research or talk to a licensed professional before making any decisions. At a high level, ESE Entertainment is not a game developer, and it's not an esports team. It doesn't rely on making a hit title or paying players to compete. Instead, ESE operates behind the scenes as infrastructure. Think of it as a production and technology company that helps major brands run large-scale live events, broadcasts, and digital fan experiences. The core of this business now runs through its subsidiary, Bombee Global Entertainment. Bombee handles live production, broadcast execution, digital overlays, fan engagement tools, and event logistics. That means everything from setting up the physical event environment, to managing the broadcast feed, to integrating digital features that let fans interact in real time. This positions ESE right at the intersection of live sports, esports, and digital media. What's important here is that this is a service business. Clients pay ESE to deliver mission-critical events. If the broadcast fails, the client looks bad, not ESE. So once trust is established, these relationships tend to be sticky. You don't casually switch production partners for a world championship or a title fight. That brings us to the bull case, and it starts with growth that's hard to ignore. In the third quarter of 2025, ESE reported revenue of roughly $3.7 million, up more than 100% from the prior quarter. This wasn't a year-over-year comparison. This was quarter-over-quarter. At the same time, gross margins expanded into the mid-teens, and adjusted EBITDA flipped positive. For a microcap in this space, that combination is rare. You usually see growth with heavy losses, or profitability with stagnation. ESE delivered both. The second part of the bull case is where that growth is coming from. In late 2025, the company expanded Bombee's operations into the United States. This wasn't a speculative move where they opened an office and hoped customers would show up. According to management, the expansion was accompanied by signed U.S. contracts. That matters because the U.S. market carries higher contract values and better margins than many international markets. In simple terms, the same production work tends to pay more. The third bullish factor is client quality. ESE isn't working on small experimental projects. It has handled production for the Call of Duty League championships, partnered on WBC boxing events, and supported professional soccer launches. These are high-pressure, high-visibility events run by organizations with massive budgets and high standards. Successfully executing at that level creates a reputational moat. Once you're trusted with events like these, landing the next contract becomes much easier. Another tailwind is structural. The entertainment world is moving toward what many call phygital events, physical experiences enhanced and monetized through digital layers. Fans may attend in person, but the majority engage through streams, apps, betting integrations, and live data. That trend doesn't depend on one game title or one league. It's a broad shift in how entertainment is produced and consumed, and ESE is positioned squarely in that infrastructure layer. On paper, that's a compelling growth story. But that's only one side of it. If you're getting value from this breakdown, tap like and subscribe to Penny Stock Pulse. It really helps the channel and tells me to keep making these deep dives for you. Now let's talk about the bear case, because this is still a penny stock, and the risks are real. The first risk is client concentration. When a large portion of revenue comes from a small number of major clients, losing even one can have a material impact. If a publisher or sports organization decides to bring production in-house or switch vendors, revenue could drop quickly. While exclusive and repeat contracts help mitigate this, the risk doesn't disappear. The second risk is execution. Expanding into the U.S. increases overhead staff, facilities, and operating costs. If revenue growth slows or contracts are delayed, margins could compress. The recent margin expansion is encouraging, but investors need to see that discipline maintained as the company scales. Liquidity is another concern. ENTE F trades on the OTC with relatively thin volume. That means price swings can be exaggerated in both directions. Large sell orders can push the stock down sharply, even without any change in fundamentals. This makes position sizing and order discipline especially important for anyone involved. There's also balance sheet risk. Like many microcaps, ESE has used financing tools such as convertible instruments in the past. Depending on terms, future conversions could add dilution. This doesn't negate the business progress, but it does affect how upside translates on a per-share basis. With those risks in mind, let's briefly touch on the chart and valuation context, because that's where some investors focus. From a technical standpoint, the stock recently moved above its longer-term moving averages and established support in the 5-cent area. Volume has expanded on up days, which some traders interpret as accumulation rather than random trading. Momentum indicators are not stretched, suggesting the move hasn't reached euphoric levels yet. On valuation, the disconnect is straightforward. At a market capitalization in the high single-digit millions and an annualized revenue run rate, potentially north of $15 million, the stock trades well below what profitable production and media infrastructure companies often command. Even modest multiple expansion would imply a meaningfully higher valuation. That said, markets don't re-rate companies just because numbers look cheap. They do it when growth and profitability prove durable. So who might this be for? This setup may appeal to investors who are comfortable with microcap volatility and who focus on operational inflection points rather than hype cycles. It suits those willing to track quarterly execution, contract announcements, and margin trends closely. It's less suitable for anyone who needs liquidity, predictable dividends, or low volatility. The core thesis someone would need to believe is simple: that ESE can continue scaling production revenue, maintain or improve margins, and retain Tier 1 clients as live and digital entertainment continue to converge. To wrap it all up, ESE Entertainment represents a company that has quietly transitioned from speculative esports exposure into real entertainment infrastructure. The upside case rests on revenue growth, improving profitability, and structural industry tailwinds. The downside comes from client concentration, execution risk, and microcap liquidity. If you found this deep dive helpful, hit like, subscribe to Penny Stock Pulse, and turn on notifications so you don't miss the next under-the-radar breakdown. Thanks for watching, and I'll see you in the next video.